this slow moving decline in the quality of credit could become an avalanche of decline. And this is where Double B, Bill by Mel, the debt doctor, comes in and says, it looks like the patient is sick. And the patient that I am talking about is the CLO market. This market has hit an all-time high in terms of volume, and it hasn't stopped in the last 5 years. I think almost $100 billion of new issuances of private credit CLO deals. These are collateralized loan obligations. The rise of CLOs and the rise of private credit and this whole layering of securitizations and huge tranches of 100 million, 200 million, and billion-dollar lines of credit, it all comes from the banks not wanting to extend as much credit. The private credit market that CLOs funds is folks that are non-institutional grade borrowers. What we are seeing today is write-downs. And when the write-downs come on this credit, these CLOs are marked by the CLO managers. So there is an inherent desire to do nothing to downrate the quality of your credit or your book until an actual crisis happens. We've seen this happen a few times already in the last few years. And my bold prediction for 2026 is that we are going to see this happen again. This could be the next MBS failure. It could spur a complete opening, eye-opening of the market, a paradigm shift, and finally be one of these kind of existential, systemic risks to the financial system here in the U.S. Welcome to the Debt Doctor Podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill by Mel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, and good evening. Wherever you're joining us from today, thank you for joining another episode of The Debt Doctor. My name is Bill by Mel. I appreciate that you spent a few minutes with us today. Today, we are having another Coffee with Bill episode. It's just me alone you're going to have to listen to for a few minutes. Today is the story of what I would call the risk of the double Bs. And the risk of the double Bs means a lot of things. I am going to start by saying the double B is my name, Bill by Mel. So wherever we start the conversation, I always have to take some responsibility for it. But where I'm really going to get into is double Bs with regard to new derivatives that exist in the market. Looking at places where the most risk exists. And, we know that we are living in a world that just doesn't seem to compute. Costs are going up, profits are getting squeezed, and yet the stock market is an all-time high. Housing is up 50% from 5 years ago in terms of value. There's just a real disparity, and it causes a lot of head scratching for us, whether we're just regular individuals trying to make a living or you're an active investor in markets. It's hard to know which way to go or where the risks are because everything seems so similar. There doesn't seem to be a down anywhere. Well, I think that time has come to an end. And really what today is about is taking a bold prediction for 2026. I do believe this is the year that private equity has a reckoning. And where I think that most applies and most comes in contact with my world of real estate mortgages and real estate investment is in the area of CLOs. That's collateralized loan obligations. Many of you know that MBS, mortgage-backed securities, was the type of investment derivative that caused the failure of and the mortgage crisis, which we have now referred to as the GFC or the Great Financial Crisis. That's period that started officially. Most people point to 2008. They point to the failure of Lehman Brothers in the fall of 2008 as the nail in the coffin for the market and especially the securitization market. But really kind of that it started with the failure of Bear Stearns many months before that. And really you started to see the writing on the wall in 2007. By the way, just take a moment here. If you like what you're watching, listening to, wherever you get your podcasts, please subscribe, join the family, join the community. We're trying to build a conversation about what I think is a very important topic, and that is the rising amount of distressed credit and distressed debt that exists around the US, around the world, for instance. And where we specialize here at the Debt Doctor, where I come from, is in the world of real estate debt. I have been buying mortgages, non-performing, sub-performing mortgages for almost 20 years now, since just around the time of the GFC, the summer of 2008. I bought my first mortgage 3 months before the fall of Lehman Brothers. So I have a little bit of experience with market cycles and and I'm constantly looking for the writing on the wall. In many ways, we were kind of at that cycle in 2019. And then COVID came along and thought that we were going to see a huge number of defaults and a huge crisis come, which obviously the federal government, the US government, and the feds, the Federal Reserve, the Treasury did a fantastic job of staving off any crisis. But, in the short term, it was a fix. And in the more near term, meaning today, what the result of the fix, which was let's dump a bunch of cash, $6 trillion, $7 trillion, let's print that money and put it in the hands of consumers and businesses through PPP, through loans, through forgiven just from handouts. Let's lower interest rates to a point where it's of zero, where the cost of money is absolutely nothing. And what that caused was, rather than a crash of the markets into 2020 which may have been brought on by COVID, but even in a natural state, if COVID didn't come around, there may have been a natural correction that was on the horizon around that time 5 years ago. Instead, what happened was the markets and asset values went in the opposite direction. And we are now 5 years out. Coming up on 5 years now since the start of COVID and the creation of new printing cycles and a 2-year stint of zero cost of capital. Exploded the price of everything, especially real estate, by 50%. 35% inflation. The cost of goods is up 35% in the last 5 years. Where does that come from? Well, it's pretty simple. If you look at bank reg data or any provider of insight into the call reports, the bank deposit accounts themselves show a $5 trillion jump in available cash sitting in bank accounts of Americans and institutions since 2020. And that alone is where probably most of the inflation has come from in the last couple of years, is this excess cash. There was really no way to predict what $5 trillion of printed cash could do to the market and how long it would stave off the natural next cyclical crisis. But the reality is markets are cyclical. Where we're starting to see the cracks as it relates to our business is we are seeing a rise in mortgage foreclosures on the residential side. While there is a interesting dynamics in residential real estate because of the fact that a majority of mortgagees, people that have mortgages on their houses, did refinance during those super low rates. And so you've got more than 60% of the mortgage properties in the US that are sitting at fixed interest rates below 4.5%. And when today's mortgage market is offering at best 6.5, most likely more something like 7.5% conventional mortgages, which is more aligned with the reality of normality, it is very difficult to see anyone who refinance. It's very difficult to see anyone be motivated to move. So a good portion of the American residential population is kind of stuck in these low interest rates mortgages, which I'm sure they're not complaining about. There are other factors to residential that are playing a role. The rising cost of insurance and taxes is squeezing those that are close on their debt to income ratios, and so residential is a different world. What has happened, and what is a slow moving failure in credit markets, which could, in this year, in 2026, and this is where we get into the bold predictions, in 2026, this is where this slow moving decline in the quality of credit could become an avalanche of decline. And this is where Double B, Bill by Mel, the debt doctor, comes in and says, it looks like the patient is sick. And the patient that I am talking about is the CLO market. It's private credit. It's probably the most the most important piece of today's private credit market. These are leveraged non-institutional loans. This market has hit an all-time high in terms of volume, and it hasn't stopped in the last 5 years. I think almost $100 billion of new issuances of private credit CLO deals. These are collateralized loan obligations. And I'm going to spend a few minutes getting into them because this is where I think we should keep our eyes out. This could be the next MBS failure. This could be the kind of thing where if it gets out of control and we see enough CLOs fail, or even a few what we thought were quality CLOs fail, then it could spur a complete opening, eye-opening of the market, a paradigm shift, and finally be one of these kind of existential, systemic risks to the financial system here in the US, just like MBS was. Okay. A collateralized loan obligation is a financial instrument. It is a securitization. So they maybe call it a different thing, CLO. It's not that different than CDOs, by the way, collateralized debt obligations, which are known to be like thrown in the trash these days. The CDOs were the types of derivatives that the types of gambling investment vehicles that blew up when residential mortgages went the other way, when residential prices went down. But CLOs are really just a remanufacture, rewrapping and rebranding of the same thing. And this is where you get into the risk of the double Bs. This is where what this is about. Double Bs refer to what is known as the riskiest. The usually it's the double Bs, or if there are Bs, that's actually the riskiest tranche of the CLO. The CLO is a group of loans. So it goes out into the private credit market. Let's say CLO goes out and raises $10 billion, okay, through private credit markets. They put a billion to one, they put a half a billion here, another half a billion here, another half a billion here, another 200 billion here. And so the CLO manager goes out and creates this CLO, it is a securitization. They tout it as much more transparent, much more managed, much more regulated than the MBS of the GFC days. But that is a little bit of a misnomer and not true. We'll come back to that in a second. But basically, these managers go out, they raise $10 billion. They buy 30 different investment tranches of pools of private credit loans. So they'll go to, you'll get a CLO manager, you'll go out, BlackRock is famous for their investments in CLOs, and a lot of it being their own money. And they'll go out and invest in multiple tranches that each have loans. And, to believe that these folks really know what it is that they're invested in, it doesn't really make a lot of sense. And you've seen me have some interviews with folks like Chris Whalen or Bill Moreland, who are guys around the banking and securitization world. And the reality is, what the problem with private credit and where we talk about it is in relation to the banks. The banks are even giving money to some of these CLOs. They're even leveraging some of these CLOs. So they're even taking a higher tranche position, so to speak, on the CLOs. So, and where this becomes a problem is that the rise of CLOs and the rise of private credit and this whole layering of securitizations and huge tranches of 100 million, 200 million, and billion-dollar lines of credit, it all comes from the banks not wanting to extend as much credit. Really, where the people that go get CLO loans are folks, well, they'll say, oh, they just don't want to deal with the banks. No, the banks have a much more stringent credit profile. So the private credit market that CLOs funds is folks that are non-institutional grade borrowers. So the entire market, and the majority of borrowers in the CLO market are borrowers who cannot apply and be qualified for traditional bank financing. So the entire thing already has a credit de-enhancement, so to speak, to begin with. And then I'm to believe that some young guy at a private equity firm that's just trying to originate this $15 billion bond he and his credit team, while they may have done their due diligence and everything looks good on paper, do they really have the experience, the knowledge, and the credit acumen that outweighs a banker? So you already have to assume this is a lower quality of credit. And so as much as ChatGPT or the standard industry sentiment is that, well, CLOs are more transparent rather than what is different about them. Let's just say, the argument is these are not like the RMBS or the CMBS loans that failed miserably and almost brought down the financial system in 2008. But the reason that the private equity guys and the regulators will tell you they're different is that those MBSs were based on individual borrowers with jobs and their employment and house price appreciation, which I never thought housing price appreciation should ever play a role in factoring whether somebody can pay off their mortgage. And then these people, advocates of CLOs, will say, well, they're backed by senior secured corporate loans. and that they're based on the borrower's EBITDA and covenants and operating cash flow. So they're really companies that are already existing. Well, we've seen companies go from profitable to non-profitable overnight. We've seen EBITDA decline overnight. And we've seen in the last 3 months, several multi-billion dollar companies just blow up. So if you talk about the transparency aspect, then the proof is already in the pudding. You just look at Tricolor, you look at First Brands, you look at Renovo Holdings, you look at HPS Investment Partners. There are there are a dozen billion-dollar failures that have happened just in the last 3 to 6 months. So from a structure and transparency point of view, I don't buy the fact that CLOs are more single layer structures, more standardized, that they have detailed lien loan level disclosure, reporting frequently, and they might be structurally simpler. They might fall into a more simple form, but that definitely does not mean that the managers who are who are managing in these CLOs really have any understanding of the individual credit quality of the borrowers that are in these pools. And that's where you get into trouble. We've already seen BlackRock, and this is outside of the real estate world, by the way. A lot of these CLOs are just company backed. So there's very few hard assets. If a company fails, a lot of times these companies making, $20 million a year of profits, $60 million a year of revenue. If that goes to zero, or if a company starts losing money and the cash on hand runs out, the assets that they're tied to, what do they own? Office furniture. There's not a lot of corporations don't have a full, like a large amount of assets. They're not McDonald's. They weren't real estate investors that can say, point to the land they own. And even when you look at, certain operators of corporations, in the retail field, at least over the years, they owned real estate, or they owned leases, like large department stores. They built assets and equity through the signing of long-term leases, through the purchase of land, through the purchase of building, through the purchase of other companies. I venture to say that a lot of the companies out there that have large lines of credits that are stuck inside these CLOs, some of them don't have real estate assets to back them. But we're focused on the real estate sector. So let's just even come back to that, where we do have real estate, real assets to back it. Well, we've seen an absolute decline in the squeezing of revenue, of profits, of NOI in real estate. And where does this come from? Well, it's very simple. Insurance costs are up tremendously. Some states in this country, like Florida, if in commercial real estate, you almost can't even afford to pay for insurance. You're better off self-insuring, and we're seeing a lot of people do that. Taxes have gone up because property taxes are often tied to the value of real estate, which has gone up as itself 50% in the last 5 years. Interest rates. As interest rates have increased, the many people have adjustable rate mortgages, so their costs have increased. So you can go, as a prime example, if you had a 3.5% or a 4% mortgage that was an adjustable rate mortgage in 2021, and say you had that income on a piece of commercial real estate that you owned for years, but you maybe got this mortgage 3 years before that, so you're 4 years into a 4% mortgage on your commercial multifamily or retail building. Well, 2023 rolls around and interest rates start to spike. And now that 4.5% mortgage is 7.5% or 7%. Well, in those cases, if you had a 1.2% debt service coverage, so let's say none of your other costs went up, but your net amount of tenant income derived from rents was 120% of what your 4.5% mortgage payment was. And if that mortgage goes to 7%, you now are at below 100%. Your cost of that debt payment is now going to be more than that total amount of tenant rents due. And that is a very common thing going on in any type of investment real estate, whether it's residential real estate or commercial real estate. We are seeing a DSCR crunch, a debt to income or a debt to service coverage ratio collapse that is causing a huge amount of distress in any type of investment real estate. Now, most of commercial real estate is investment real estate. Pretty much all of commercial real estate is investment real estate. So that applies to this sector in perpetuity. And then you have a good amount, about 14 million investment properties on the residential side, which also this could apply to if you are using a fixed leverage. What's also come along with that is because interest rates have gone up and the cost to invest in, or the cost to put your money in a savings account is now paying you a certain flat amount of money. So you can go put money in a savings account, buy a US bond, and get a 4%, 5% floor, whereas you could get 0 or 1% 4 years ago. Well, if that's the quote unquote risk-free investment, well, now the expectations of all other investments has gone up. So in commercial real estate or in investment real estate, that means the cap rate expectation of buyers has gone up. And as the cap rate expectation of buyers has gone up, that means that the value of the real estate relative to the income on that property has gone down. So it's another area where commercial real estate owners and residential real estate investors are getting squeezed, because whereas an investor might have been willing to buy a multifamily low-rise community building in the Midwest for a 4.5 or a 5 cap a few years ago, which never really made sense to me, they are now waking up to the reality that, well, if I could make a 5 cap just buying treasuries, if I'm going to invest in this 200 unit complex in Wichita, Kansas, and deal with everything that I need to deal with to manage and profit and be a landlord, well, then the baseline for that now is going to be 7 or 8 or 9% return. That increased expectation on return squeezes the value of the real estate. So now that's what exists inside commercial real estate or investment real estate. And a lot of CLOs that exist out there today are based on the net income coverage and what the borrowers can cover. So what we are going to see, and what we have seen already in small factors, you're not seeing a lot of it in the public. Look at the Money 360 CLO. Look at a couple of others that exist out there. What we are seeing today is write-downs. And when the write-downs come on this credit, these CLOs are marked by the CLO managers. So there is an inherent desire to do nothing to downrate the quality of your credit or your book until an actual crisis happens, till a borrower stops paying, until there becomes a problem. And we've seen this happen a few times already in the last few years. And my bold prediction for 2026 is that we are going to see this happen again. So why is that important? Because the double B tranches is what the controlling class of these CLOs are. There is, it is the lowest stack on the totem pole in terms of payback if these CLO, these bonds fail. And it is going to be an interesting time if we start to see failure of these CLOs. In the meantime, you look at BlackRock stock, which is one of the largest investors and managers of CLOs. They are up, 15% in the last year. At the same time that they are writing off $150 million loans to credit companies, like their investment in HPS. So we are going to see more of that. And if I really want to tell you the bold prediction for where is the double B, the risk of the double Bs, well, I've been saying it for a year, and I'm going to quietly say it here. I believe we are going to see a failure of some major private equity firms and some middle market ones. There are walking zombies, not just in the banking industry, but in the private equity world, and it could go to the top. My prediction is keep an eye on BlackRock, keep an eye on Blue Owl. Those are the double Bs that I think have extreme exposure. You know, BlackRock has about $9 billion of cash on hand. They manage $30 billion of CLOs. They have a $117 billion market cap on there as being traded in the stock market. Something is disconnected here because they are quietly downgrading some of their credits, at the same time creating new credits and bringing some of that to the retail market, just the way MBS came to the retail market in the middle 2000s. Watch this space. 2026 is the year of the double Bs. It's the risk of the double Bs. It might be the year of the double B Bill by Mel, bringing you more interesting conversations like this. If you liked what you hear today, please do subscribe, share us with your friends, make a comment, reach out to me. You know where to find me. My name's Bill by Mel. I'm the Debt Doctor. Thanks for joining me for coffee today. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.